Hi, and thanks for watching episode 2 of our Trader series. My name is Vincent and I work at Maven. Today I would like to discuss the dynamics of market making. Market making is basically the basis of our trading sector. And I brought two simplified examples of what market making entails. And the first one is a very intuitive example. Let's say you have £100 to spend on a holiday in the US. You go to the airport, to one of these money exchanges, and you want to swap those pounds into US dollars. Well, today you get roughly 120 US dollars for that. You spend 2 weeks in the US, but you don't spend any money there, because you get paid for whatever reason. Now you return to the UK, and you go back to the money exchange, and you want to swap back your dollars into pounds. How many pounds do you think you get back? Well, the answer is less than 100, obviously. Let's take, for the sake of the example, 95. So the money exchange returns you 95 only. So, in essence, the money exchange acts as a market maker. They pocket £5 there. But what they also did, they provided you liquidity. So on your way to the US and back, they were allowing you to actually swap your currency around. That's a service. The other example I would like to give is that competition between market makers, the money exchange in this case, is also beneficial for the client. And the client in the analogy, that's me traveling. Because imagine there's a second shop opening next to the other money exchange, and that second shop returns you 96 or even 97 pounds on the way back. Then probably you would love to go to the other shop, right? And if there's a third shop giving you 98 back, then number 1 and 2 already get bankrupt quite quickly. So you can see the moment market makers start competing with each other, it's beneficial to the clients. The second example I brought is a bit more in detail, because I needed a bit more of the numbers. And this is a story about a shop that buys and sells refurbished smartphones. So let's say I'm one of those shop holders, I'm a market maker in that sense. And at any moment in time, I would value this refurbished iPhone based on some sort of mathematical model. So we call that intellectual property. And let's say today my valuation would be $225. It's very important for you to understand that never ever would a market maker tell or give away this 225 number. Instead, what he does, he shows the world a price for which he's willing to buy this iPhone, in this case 200, we would call it a bid. And obviously this 200 is lower than the 225, his intellectual property number. And also he's showing a price for which he's willing to sell the smartphone for, which is 250, a bit higher. Right? So we call this a bid and an ask. All right, I illustrated it in a small picture. So this is the shop holder, the market maker. He says, I can buy for 200 and I'm willing to sell for 250. And these people down here are customers. So for example, this guy, he says, hey, he's holding an iPhone, you can see that. And he said, I can sell my smartphone for 200. And this guy doesn't hold a smartphone. He said, hey, I can buy a smartphone for 250, which is something that you need to take into account. The market maker says, I can sell for 250. So if you are a client and you want to buy, you have to pay the higher price. And vice versa, if you own an old smartphone and you want to trade against the market maker, you can only sell it for the lower price. So that's from the customer's perspective. So now I created a couple of scenarios. So let's say this is day 1. The shop is open. This is the market maker saying I'm 200 at 250. This is how we would say it. And now there are 5 customers and they're willing to sell their smartphones. And they say, I can sell my smartphone for 200. That's a good deal. Let's do that 5 times. So the market maker is buying 5 smartphones at a price of 200. You can see them even in the window there. And he's kind of happy. He bought 5 iPhones at a price lower than 225. So he actually accounts for a profit, let's say. So let's say the day is over. The second day starts. Same story. And now 2 more customers have the same philosophy. They can sell their smartphone for 200 and the market maker is buying another 2 phones. So you can see right now the inventory is piling up. You might already see where this is going. His manager is going to walk up to the market maker saying, why are you buying all these iPhones? When are we going to make money? Well, you can only make money if you're able to sell them out for a higher price. So where the problem really is this. On day 3, let's say, he shouldn't put 200 and 250 there anymore, because the pattern will keep on repeating. So the big question is, what sort of prices should he show to actually make a good profit out of it? So this is where he started. And hopefully by now you feel we should attract buyers. We should go down with our prices, right? So let's go down. Let's say on day 3 we go like this, 100 at 150. It is the right direction, but it's too low. You can see, if you are a customer and you want to buy a smartphone now, you can buy it for 150. Remember the customer's perspective? Instead, yesterday you had to buy 250. So that's a nice trade, but if you think from the market maker's perspective, it's like, hey, yesterday the market maker bought a smartphone for 200, and today he stands to sell it for 150. Well, that's actually losing, right? So this is not a great suggestion, and this is also not a great suggestion. Well, it's so much similar to the previous day. So a decent follow-up market would be, we call it a market or a quote anyway, would be something like 170 at 220. Because what can happen, for example, now, someone could be interested in buying a smartphone. Yesterday he had to pay 250. Today he can get it for 220. He might fall for it. Okay, that's a good discount. And the market maker is selling at 220, and yesterday he bought at 200. So there's an actual 20 pounds profit in there. No? Okay, small jargon, 200 at 250. All these things are called a market or a quote. So that's where the terminology market maker comes from. And the second thing, the spread. This is the spread, the difference between 200 and 250. I chose it a bit randomly at the start. I chose it centered around the 225, remember? But I could have said 150 and 300 as well. The spread typically reflects on how certain you are about the 225 number. If you have no clue what the phone should be worth, then probably it's wiser to make 150 at 300. And if you're very confident about the value, you can make it even tighter than that. Okay, so these were two small examples of what market making entails. This is how it looks like in reality. Now we talk about stocks, actual financial products. And a stock is not one number. A stock will collapse into an order book. This is, by the way, what episode 3 is about. But you could see there's a market maker willing to buy a particular stock for 99.99, and he's willing to sell the stock for 100.02. And there are many market makers typically in the financial markets. And this, as I will show in subsequent modules, will collapse into an order book. You can see, for example, you see 99.99, there's 100 people there, and 100.02, there's 300 people there, but that's like 100 of this first market maker and 200 of this second market maker. So all these market makers will collapse into what we call an order book. And that we will cover in the 3rd episode. So stay tuned for more.